Welcome to the GraySwan 2021 Macro Outlook. My name is GraySwan's. I'm Head of Research at GraySwan. So firstly, let's start off with looking at COVID-19 infections. We've seen in the dark blue line various infections or waves of infections running through the US, and the good news is that we've seen big declines. Unfortunately, Europe has struggled, but we are seeing some positive signs in terms of Europe. On the right-hand side, we look at the Google Mobility Index. And what it does, it looks at the movement of people in the retail and the recreational centers. And there, unfortunately, what we can see is that lockdowns are still firmly in place. And we need the world to start moving and returning to normality for economies to start growing quickly again. And how do we get there? Well, we need to look at vaccinations. Leading the pack is Israel. Israel is vaccinating 60 out of 100 people in the population. That's followed by the United Kingdom and then the United States. So vaccine rollouts are happening. And the rollout of these vaccines are going to be critical for each country. Even in South Africa, we have not started rolling out the vaccines, and it will be critical to open up this economy. So what do we need to look at? We need to look at when can we start returning to normal. And that's going to depend on herd immunity. So looking at projections, the US should reach herd immunity by December 2021, the UK, August 2021, and unbelievably, Israel towards the end of February 2021. So that's great news. What we need to look at, though, is whether the vaccines are helping to get less people sick. And that's really the key here. And on the right-hand side, what we look at is the number of doses per people in Israel and the number of new severe patients per day. And the good news is what we're seeing the steady decline. We will have to keep looking at these numbers because that is going to give us a very good indication of what's going to happen across the globe with vaccination rollouts. But markets look forward. Markets look at where economic data is going and whether we're through the worst of the news. And this is just a projection on growth for China, US, Europe, UK, and Japan. And unbelievably, China has actually recovered from the COVID-19 pandemic within 1 quarter. China is growing again. Most developed markets would take 2 to 3 years to recover. Unfortunately, by IMF, poorer countries such as Africa, typically 3 to 5 years. But what we're seeing is growth projections coming through. In terms of China, one of the biggest economies of the world, you look at the China credit impulse, and it's really the change in credit as a percentage of that population. And you can see those are some positive numbers coming through. So we're seeing economic activity there. Then we look at Dr. Copper. Dr. Copper is really an indicator of the economic cycle we're going in. And copper is a commodity used in most of the industries. And as economies start recovering, you're seeing this demand for copper coming up, and then that should drive copper prices higher. And that is what we're already seeing. So that should or could bode well for other commodity or industrial commodities as well as we start seeing this drive to infrastructure spending going forward. Then we look at the US personal savings rate. And at the end of the day, consumers drives economies. And what we can see is that the US consumer has more money today than it has during the 2008 financial crisis. Why? Because of the CARES Act. But the consumer has got a lot of cash that needs to be pumped back into the economy. So that's positive news. In terms of inflation, we believe inflation is key in this environment because where inflation is going to go would drive prices of asset classes. Especially in certain sectors of the equity markets. With the yields being so low, investors didn't really have an option to go to buy global bonds. But as inflation starts rising and if yield starts rising, there may be a rotation out of this. But looking at the equity markets, it has only been one place to be invested, the equity market, because of low bond yields. But it comes with risk. The equity markets is priced today at very expensively back at levels we've last seen during the 2000 tech bubble. But I think there's cheaper sectors within the equity market where you should be rotating into. And this is what I'm talking about. This is the two main sectors or styles, you want to call that, growth versus value. And this graph just shows you the dispersion of returns relative to the index over 10-year rolling periods. And you can see how far value stocks have underperformed growth stocks. We've last experienced this during the 2000 tech bubble. And we think as yield starts rising, there could be this rotation out of these heavy, expensive tech companies or these growth stocks into more value-orientated companies. For South Africans, we live with the rand every day, and where the rand was trading at 19 rand to the dollar, we had clients that did panic and want to take money abroad, but our view was that some normality would come back. And today the rand's trading at 15 rand to the dollar. Our view is still that the rand could strengthen even further, as it's still trading above fair value, but a lot of it will be driven by the US dollar. So you need to look at the US dollar. And what's the view on the US dollar? Well, this slide in orange shows you the effective exchange rate of the US dollar. And then gray shows you the twin deficits. And you can see the two lines move quite closely together. The twin deficits of the US, all that it means is that the US is importing more than it's exporting, and it's using more money than it's actually generating or making. And typically environments where you have big twin deficits like we're seeing in the US dollar actually structurally weakens. So we could be in this phase where the dollar keeps weakening. We've just been through a 10-year bull market in the dollar, and it runs through various cycles. So in summary, looking at where we think the world is going to, we think we're going into this growth environment and for a reflationary environment where inflation returns. And that means you should start looking at the top right corner there, where these asset classes should do well, meaning emerging market currencies, emerging market equities. We've already started seeing emerging market equities really during the beginning of 2021. You need to look at value type of stocks, US real estate, industrial commodities. You're probably going to see some of the biggest global spending the world has ever seen in terms of infrastructure spending to try and stimulate economies. There will be a need for commodities. So we think there's potentially opportunities. Then at the bottom there, I included megatrends. And why do we include megatrend into every block there? Because we think it is an asset class or a trend that should do well during all phases of the economic cycle. And what is a megatrend? So a megatrend is a trend or a change in the way the consumer reacts or spends. And let's take you through an example. I was born in 1976, and growing up in that era, my parents used to listen to vinyl. Then you had tapes there, and you had radio as well. But then you had the introduction of CDs, and you can see how our CD sales just took over vinyl. It's a complete disruption. And companies that just focused on vinyl typically went bankrupt. Then towards the mid-2000s, you had this age of digital music, and that completely disrupted CDs again. And today you've seen companies closing down, such as Musica. So the point behind megatrend, it is something the way the world works, or the consumer spends his money and the way he changes over time. What is the next trend? Well, we think the biggest next trend you need to look at is climate change. The drive towards climate change will be dramatic. We've just seen President Biden rejoining the Paris Agreement for climate change. President Trump took the US out of that agreement. Biden has come back in. There will be a massive amount of money being spent on climate change and on reduction of carbon emissions. On the left-hand side of this slide, this is just looking at the EU, and it shows you the 5 biggest sectors within the EU which has high carbon emission rates. On the right-hand side, it gives you the predictions in terms of zero net emissions for these big sectors. And power should reach zero net emissions towards 2045, approximately. But there's a big drive towards towards carbon emission reductions. Furthermore, the EU wants to spend roughly $25 trillion US on investment spending into these sectors to reduce carbon emissions. So the amount of money going into these sectors will be massive. So how's the world changed? Are we already seeing the change in the way consumers spend? And the answer is yes. If you look at the percentage of electricity generation by wind and solar, you can see Germany generates 42% of its electricity already is generated by wind and solar. United Kingdom 33%, Australia 17%. And you can see where the rest of the world is. This is a mega trend. The world is changing. And companies that focuses on low carbon emission or has technologies that works or produces electricity in these areas should do very well. So the next slide just shows you over the last 9 months, and that's from the point, if you look at the US election as well, what's that done for clean energy or for renewable energy investments. These are 5 clean energy ETFs, and you can really see that just over the last 9 months, all of them has performed almost in excess of 150% in 9 months. So these sectors are doing very well. And therefore, we believe that you need to look at long-term trends or mega trends, and these are the sectors that should do well in the long run. Thank you for joining me, Gregor Theron, for our macro outlook. Look after yourself and stay safe. Bye-bye.